Hello guys, and glad to have you on board again today. TL number 3. Today is a new camera setting, so I hope you're going to enjoy it. It is probably going to be a lot more pleasant to you. But anyway, this is just cosmetic stuff, so let's stick to the essential. Today we're going to introduce the notions we've been talking about on the previous podcast, which is the heart of the problem, which is risk management and what that thing actually means. Because this is a very complex stuff, very hard to define. At least the limits of risk management are pretty blurry. And I would even say that there are no clear definitions. There would be as many definitions there as there are traders out there, as basically each and everyone has its own vision of risk management, even though normally most of professional traders should agree on some basics. The basics I'm going to try to share with you today, and at least giving you a glimpse of what that is and the easiest way I could possibly explain this very blurry topic. So understand that this is definitely not a definition I'm getting out there, just my personal vision of it, trying to make it as rational as possible for you guys to understand this thing. So let's get it started. All right, we're going to get started with this first chart in here. Once again, this is totally subjective stuff, so I'm just using this as a reference point to get you easier way of understanding what this is all about. So this is just, yeah, somehow something that helping me to be more rational for you to read. So what is going on with this chart? So XY axis, and we're going to consider starting with this gray line in here, which represents just one thing to me, versus the blue line, which is going to be the a target we're going to try reaching out to over time. Is that normally risk management is supposed to kind of leading you from these gray lines toward the blue line. What it represents is the reference of chance versus statistics. So chance is basically what you're going to get confronted to when you first get into trading, which means you actually don't know shit about risk management. You might have heard about it, but you don't necessarily really apply those things. Though you basically, on my point of view, are the gray line, which means you're going to rely to your luck. Or even though in here this is a pretty nasty word, I'll get simple saying that, well, it's not just about luck, but luck is basically the easiest way to put it into perspective, which means it's going to be randomly oscillating through time and you'll have absolutely no control over this. Basically, at some point you're going to be lucky, you're going to make some gain. At some other points you're going to be unlucky, you're going to make less gains, more losses, whatever. And therefore you got somehow of a absolutely close to zero expectancy for gains, okay? So even though in here we could say that markets are generally uptrending, which means if you're buying a little bit more than you're selling, just not making it totally random, you should get something approximately positive. But still, there is a very, very impactful stuff going on in here. Psychology, which means psychology and the new biases, the most well-known of them being that you generally cut your gains and let go with your losses, which generally ends up totally destroying. So even if you're lucky, unlucky, and have kind of a tiny bullish perspective of return and positive return, you're probably not going to get it because psychological behaviors will totally wreck those possibilities for you to be effective into trading. So in here, considering it, the probabilities in which you're going to be right and wrong and how you're going to manage them through time. So trading management and risk management is normally supposed to increase slightly your rate of success. That doesn't mean you're going to succeed each and every time. That doesn't mean luck and bad luck isn't out of order. That definitely doesn't mean that those external factors that we simplified in here as being chance are not at play. They definitely will be there, and there's not even a chance you can have a flat line out there. It's just what we care about is that the linear reduction of these amplitudes, luck, bad luck, whatever external factor implicating your trading decisions, then on some point you still have something positive. Okay, that's what risk management is heading to. That's the goal. That's what you want to get. Coming out of those random things to get into something that is still mostly random, of course, but positively random as you reduce the amplitude and as both in the same time, you're going to reduce these emotional impacts that negatively destroy your potential risks reward ratios. Okay, so that is the first topic. Really need to understand that. The next one is that markets are chaotic. All right, so despite this thing of lucky shots on whether your decisions are going to be rational or not, or whatever they're going to be linked to the actual others, decision makers in the market, no one knows the fuck where we're going. So as uncertainty is just a principle out there and you really get to embrace it, it means everything's chaotic. No one knows the future. A lot of people tend to predict or speculate on this or that to eventually happen, and therefore they're going to take positions in the market, but in the end, no one knows the shit out of what's actually going to happen, okay? So we need to understand that very, very factor, and you need to understand that every professional in trading has actually not just understood this basic uncertainty principle, but has actually totally embraced it. That's the reality, and this is the core element you really need to get down to. Embracing uncertainty is absolutely key into professional trading, and I'm going to try giving you a glimpse of how this thing actually works. So, as we said, statistics versus chance is what's going to improve or is supposed to improve. But in that perspective, statistics, or the way we generally do them, is that when you've got a random curve of random dots or whatever, the first things you're going to study is the linear reduction of it. Though this is what we call the Gaussian curve or normal low of statistics, in which you're going to basically study the spreading of the actual occurrences. So in here, it's basically the dispersions of our prices, because the goal in here and what actually is going to impact our equity is either us being able to predict the right move and being able to profit take before it reverses, because that's not going to be that easy, okay? So you need to understand that actually a speculative market behavior is going to destroy the basic principle of statistics by one simple alteration, in which normal low reduction and Gaussian curves are supposed to mean that most of what happens near the median price, which would be actually, in our market perspective, what we would call value. So normally we're supposed to oscillate across value, spending most of our time at the asset value. But like, you get it, right? Uncertainty principle, we don't know shit about the actual real value, and more importantly, we're not speculating on the actual value, we're speculating on the forecasts of the value in the future. Therefore, we are going to be either bullish or bearishly prospecting the value shifting. We're going to be either right or wrong depending on our lucky factors, and of course, as experience rolls in, we're going to try being as most effective as possible in here. Still, that's never going to be a 100%, and it's actually quite far from this. But the reality is that the speculative behavior and the embracement of uncertainty principle means that the market behaves totally differently than a normal low reduction. It behaves in a way that investors and therefore speculators are going to ask for prices and risk reduction. And this is where the actual risk management comes in. You need to understand that a speculator doesn't want to be right or wrong. He actually intrinsically knows that this is totally unpredictable. Even though we're trying to optimize this by external knowledge, we actually need to focus something being closer to 60-40 rather than 50-50, but still something that is random. We cannot guarantee our outcomes and our fate with the market behaviors, okay? So what we generally do is that we risk manage. Risk management, as I always try to teach you out there, is not trying to be right. It's just limiting the probabilities of you being wrong. And therefore, if you actually figure out that what we care about is price, not value. We care about value, we definitely do, but we care about price mostly because that's what impacts gains or losses. Therefore, if we want to limit the probabilities for prices to keep on going lower, as we look at buying, then we're generally going to ask for price lower than the value, which means by speculating the market, which is the absolute necessity over uncertainty, means normal low isn't at play into markets. Instead of this, we've got this distortion of dispersions of prices that generally tend to create volatility. We look at value, actually, and that's the goal of market, finding the average value, whatever thing. But the thing is that we actually don't know shit and we all risk manage. Therefore, we're asking for different prices. We're asking for deviations. We're asking for price to move in both directions so we can either limit our risks or get to profit take. And therefore, markets are oscillating from these things that we are needing to call demand and offer zones, okay? Though you need to understand what this thing is. This is what really happens in the market. This is what you know. You've never seen the market doing those linear stuff in which value is very well perceived and stuff like that. So generally, even value tends to lag prediction because, of course, speculators are anticipating the market and they're asking for prices to be either more or less important than the value, or higher than the value if they want to sell. So we're always trying to buy lower, sell higher, and therefore we create volatility. But this is, of course, absolutely necessary that you do understand that this is how market works. So your linear reductions into market, definitely not going to work. Instead, actual true risk management should give you boundaries, okay? Boundaries of price higher and lower than the value in which you're going to speculate either to the upside and to the downside. The real value, even though it's lagging, must still be studied. It is fundamental analysis, and this can very much help, and specifically on longer time frames, but definitely not what we care about in here. It is somehow secondary, even though it can be very impacting on some long-term time frames. Okay, what we actually are getting to trade is balance and imbalance of offer and demand. This is what actually risk management is about. So I think we've got more than enough to actually give a glimpse of information of what this thing actually is. Though risk management is the study of risk through time whilst assessing the value evolution. Okay, that is the conclusion we need to get down to with those first charts. Really important for you to get that one. Okay, so it is nothing more than just that. Studying this through time, and what risk management is supposed to provide is areas of price with specific clusters in which it is specifically more interesting to buy or specifically more interesting to sell. It's not about figuring out if the market is going up or down. We actually won't be able to figure this one out, as actually these informations will come out later by real evolution and real value evolution through time. So we always anticipate, we just limit the risks of being proven wrong, and we're not looking for reality, and we're not looking for truth. We're actually just looking at limiting the risk. This is what risk management is all about. I know it's fairly stupid to think it that way, but you really need to understand that this is how professionals do into trading. It might be somehow looking like it's some sort of belief that you would say that makes absolutely no sense, this is totally irrational, whatever. This is the reality, and actually you need to embrace that. So you can try to fight uncertainty principles as much as you can. You can try to fight speculative market behavior as much as you want. The reality is that sooner or later, if you really want to survive in the market, you're going to get to embrace that. And instead of looking for value, you're going to have to look for balance of offer and demand, and also sometimes their imbalance. And this is what risk management is supposed to provide. A strategy is normally supposed to help you figuring out where those supply and demands are on prices and how they evolve through time. You really need to understand that things must be evolving. That's the key factor of trading, being adaptive as much as possible. Okay, that being said, move on to the next charts, in which, okay, this one is going to be a little bit harder for you to actually get to, and I'm sorry I actually forgot to translate that one in English, but anyway, it's not going to be real complicated. As you can see, panic, which is in French, you just replaced it with a C and you totally get it, just like I think euphoria is euphoria, and you probably get it just like experience is experience, demo is paper trading, basically, and you would also get real as a real market money exposition. So what's going on with this thing? It's the actual second topic in which we actually got to introduce earlier than that, which is the psychological management. And therefore, as we just come to the conclusion that your strategy must be teaching you ways and patterns to not necessarily predict, but limit the risks of you being wrong and optimizing the entries. Like if you really want to get buying a market, you're going to get to highlight supply areas through time and waiting for prices to meet them. Okay, just like if you want to sell, you're going to look for offer areas in which prices are interesting for you to release your stocks or whatever that is that you're trading. Okay, so learning the pattern is one way, but learning how to apply those patterns in the market is going to be a very tough thing actually, because it's certainly not as easy as it sounds, and most people actually don't really get it, even though in here it's going to be totally understandable for you and you're probably going to say, all right, I knew it anyway, but still we have to talk about it. Okay, the thing is that when you get to learn a pattern, generally you're going to apply that into paper trading, which means you're going to learn the basics of the strategy by learning the rules, by looking at the patterns in historical charts or stuff like that, doing some replays. But anyway, you're not going to actively trade those patterns. So you're going to learn the basics, learn how to recognize the pattern, getting familiar with it, and switching from, okay, I don't necessarily know what the fuck I'm doing, I'm randomly lucky, unlucky shot in the market, gut trading, getting into, okay, I know a few patterns, I'm recognizing this pattern in the market, I'm going to either put myself into supply or demand areas, okay? That's what this is going to be about. Looking for opportunities in which market meets some patterns in which you actually not figure out what's going on and what is about to go on, but just limiting the risk of you being wrong. Okay? So as you get to learn this pattern into demo trading, paper trading, whatever you want to call it, there is something that's going to happen when you get to apply this into real markets. As violent the emotions will be, and just remember what we've said, psychological management through time is going to help you limiting what you feel and how much panic and euphoric you actually allow to trigger actual trading decisions. Most of the time as you get to progress, you'll get into learning that, oh shit, you must absolutely not let those things impact. Because what that chart represents in here on the vertical axis is your capacity to figure out and to process information. Okay? So it's never going to be a 100% efficient. Just don't be dumb enough to figure out that you are smart enough to figure out everything. You're not going to miss an information. You're going to mix things. Even though years from now, and this is my own strategy and stuff like that, I still make a lot of mistakes. And this is inevitable. And even if you get better through times, because those things tend to become quite automatic at some point, you still are subject to external factors. The one we've talked about, luck and bad luck is still at play, or external factors still impacts your ability to process information. It's not going to be perfect. But the thing is that as much as you get to some normal amplitude of emotion, normally things should be negligible at some point. Everyone is capable of processing the amount of information I'm going to teach you out there. It might sound like a lot in the beginning, but actually as you repeat things, it will rapidly get automatic into your system. So normally you should be easy learning the strategy. Generally takes a few weeks to actually fully understand and master a pattern. But when you're going to get to trade it is where your actual amplitude of emotion is going to get a lot larger, okay? You really need to understand that as human behavior is impacting your capabilities of processing information, there are a few natural biases of human beings that will lead you to amplifying your emotions as you get to be fully exposed to the market. As long as it comes to paper trading, assessing, looking at historical charts, whatever, you're probably going to be good at highlighting the perspectives and highlighting the patterns. But when you get to highlight them into real time, lots of things will impact. And when you're going to get to actually trigger the trade, you need to understand that both those fear of uncertainty biases and impatience biases, in which we are going to make a specific video on to actually give you quite a few tips and tricks to actually manage them. You need to understand that only real market exposition will increase the amplitude of emotion in which you're going to navigate. Demo, you're basically going to stay there, okay? Even some external factor may lead you to some euphoric or panic, depends on whatever the fuck happens into your life, okay? External factors are going to be there and impact anyway. So yeah, but as you get to trade real money, these things will definitely get a lot wider in terms of emotional amplitude. And these things will seriously impact your capacity to process information, okay? As considering it like being 90% efficiency, okay, means you're dealing very well with 90% of context assessment and 10% of things in which you're just little bending up that rule or you forgot to see that rule, just tiny mistakes that won't have massive impact. They just remain tiny mistakes, okay? They're inevitable in any way, but still, they're not that impactful. But being there, all there, it's going to be hell of an impact. Because basically in here, you're going to process half the information, which means you're going to clearly bend some rules, forget about major rules, and you're going to get to think that you're actually into either a demand or supply area in which actually you're not at all, or you're going to mix it up with some other context, and you're going to be dealing with counter-trendy stuff as you're looking at trend following, whatever you're going to do, bullshit. So you're going to need to understand that if you ever get into those areas, and believe me, you will at some point, it is really dangerous trading out there, okay? So we're going to need to manage our way into this slowly but steadily. We've introduced the manner earlier than that, saying that as you get to master a context, you're not going to necessarily go fully in the market as you get to real trading. You're going to slowly increase the position sizing to avoid unnecessary side effects. Most of it is simply being that if you get too fast, you're going to shock your brain. You're going to create a shock in which you're rapidly going to get into lack of control, okay? Fear of uncertainty. You're going to feel like all right, things are getting out of control. Oh shit, I'm not managing information. I don't know what the fuck is going on. And bam, I'm cutting the position. What the fuck is going on? Why did you cut the position? Do you actually need to? It's really what you're going to get to learn, okay? Learning that you need to rationalize each and every one of those sentiments. So actually, the strategy is not just there to teach you context. It's also normally supposed to be there helping you managing your stress and your amplitude of emotion. So normally, as you progress into the strategy, you should also progress with your psychological management. Not getting to the perfect 50%, perfect person, 100% capacity of processing information is never going to be there. But the goal is first and foremost, just like risk management is not being right, but avoiding and limiting the probabilities of being wrong, you need to process your psychology into avoiding getting into those dangerous territories, and therefore it is going to increase the probabilities of being there. Okay, and finally, I gave you a very blue line in here called experience, because of course, remember that the switching point of 2 to 3 years in which you normally get to the tipping point of your learning of the strategy and your understanding of it, then that still means through experience beyond those 2 to 3 years, you're still going to slowly but steadily progress into managing your amplitudes, which means even if you get to some extreme emotion, and that still happens, even if I am a trader, sometimes I get to panic, sometimes I get euphoric, but I rapidly understand that doesn't mean to trigger any rational information. Or if I get to trigger an information, I'm going to take 2 minutes, breathe in, breathe out, think about it, calm down. I know that panic and euphoric are inevitable at some point. They're just far rarer into my personal experience than any trader who is getting to learn, because you're less experienced than I do. Still, that doesn't mean I'm perfect. I get into panic and euphoric at some point. I just know how to figure this one out. It still happens sometimes. I'm making stupid decisions because of it. But the amount of information that gets badly processed because of it still remains normally as negligible as possible. It's never perfect, but as negligible as possible. Okay? So this is really something you need to understand. As you get to learn a new context, and there are multiple contexts in my strategy, don't try to rush things in and try to learn multiple concepts at a time, one by one. And as you get to master one, make sure you truly master it and play demo and replays and whatever, how long as this is necessary for you to think that you're in control with the pattern and that you'll be able to figure out this pattern into real-time charts without too much impact. But as you'll get into real-time, into real money trading, you're going to figure out that whether you like it or not, it's inevitable. You're going to get into extreme emotions a little once in a while, generally because of external life factor impacting and pushing you into panic and euphoric for reasons that you can actually control. So just try to limit the risk out there. You know that the position sizing is parabolically increasing your feeling of emotions. So as life will be there to fuck it all up anytime, because I mean, things are what it is and life is chaotic as well, just like trading is. So just try not to pile up too much chaos into your trading, okay? External chaos, you just can't manage it. That's what life is all about. And actually life would be boring if there wasn't chaos on it. But the thing is, you need to manage this to avoid getting into dangerous territories. And therefore, the only way you can do this is by slowly increasing your way into real money application of the pattern you've learned. Okay? Really important that you get to understand that. Finally, last charts in here, and then we'll get to conclusion. This one's really easy because it's kind of a sum up informations of the two previous ones. Though, as you get to learn techniques, though, how to highlight specific supply and demand structures, okay, and how they evolve through time and how they provide reliable trading context that limits the gut trading and bad lucks type of things, but mostly understand what markets is all about. We all trying to figure out where the market is going, and no one fucking knows. So we had to put things in motion. We had to put things in perspective, and we don't use normal low reduction. We use speculative behaviors and asking for better prices to limit the risk. Okay? So this is what techniques is all about. Rationalizing the things. It will help you being less biased, of course, through time, as progressing through more and more context will help you making sense, even though I hate that word, at least give you a glimpse of more and more understanding of patterns, and you'll be able to trade more and more market context, and therefore it is going to help managing those two biases, okay? So as you progress into technique, your psychology will inevitably progress as well, but generally tends to lag a bit, which means you get to learn, all right? This is technique, the blue one, okay? You get to learn something new, and generally, all right, your progress into learning a new context feels very boring in the beginning. You feel like you don't really get it, and at some point, I can't explain why, things are rapidly increasing. You think you really get it, you're really getting to understand, and bam! At some points, you're going to feel like a very rush of momentum in which you're going to feel, all right, I definitely think I get it with this pattern. That's fine. So first of all, make sure you truly do, okay? And that's only by practicing and practicing that you're going to make sure that you actually do automatically detect that pattern, just like if you were a robot. The rules, you finally know them and you're able to figure them out on real-time charts without struggle. You're easily getting out there. So as you do this, the first things you're going to do is putting them into real money application. But are you going to go all in immediately and expose 100% of your capital? Definitely fucking not. First of all, remember the rule we've said on the previous podcast, which means you're going to use 10% of your capital into this any fucking way. But we're not just going to stop that. We're going to increasingly get in. So get in first with the tiniest possible amount of money and get yourself into this 10% exposition as much as possible. Because, of course, the more gradient you get into this, the lesser the emotional impact will be. And therefore, even if external factor will still impact your trading, you're going to limit the probabilities of getting into very dangerous corners in which normally when chaos rolls into your strategy, you're going to make mistakes, you're going to forget about rules, you're going to bend them, whatever, but risk is going to pour in, and generally risk, I can't stress that enough, is generally leading to losses. So as you pour in the risk and navigate into this, you're probably not even going to figure it out, okay? You're probably not going to see this. But as risk comes in, generally losses it down the corner, okay? So be really cautious with that. There are a lot of predatory behaviors in the markets, and we're going to make a specific video about it later on, okay? So it's important for you to understand, getting too fast makes no sense. And psychological and technical projection are something that happens with steps. It's asymmetrical because you need to learn a new context to be able to figure out the emotional progress that comes with it. You need to progress, learn a new pattern, okay? Then apply it, confront it to real money exposition, and as you get it, you'll get to progress with your psychology slightly later on. This thing is really going with steps. I can hardly explain, but this is something I really figured out. And I still remember also back then when I was learning new context and stuff like that, I really felt like there is a trigger at the moment in which the momentum is very severe and you think you really get it at that point. Is great, but need to make sure that you truly do, okay? So I think we've got more than enough. We are finally having a glimpse of what risk management is, how we head toward it. Remember that this was this yellow line we figured out on the previous podcast. This is an imaginatory progress toward risk management, and this is somehow the combination of both technical knowledge and psychological management of putting it slowly but steadily into real money application. I think that we can get to conclusion right now. Okay, so just like we said, risk management is the study of risks through time. And we need to understand value is, of course, important factor in here. This is definitely not negligible. But the thing is that this is not just all about value. You need to process this information, acknowledge it, but knowing that normally the shift in value is what is actually going to prove you either right or wrong, but trading is not about it. And risk managing specifically is not about being right or wrong, not even seeking for being right or wrong, but trying to find the best possible way of putting yourself into the market. If you want to buy, finding a definite supply and context that is provided for this opportunity and provide best possible risk limitation for you to be proven wrong. It's not about being right, it's about limiting the probabilities of being wrong. And therefore, we're not using usual statistical reductions of normal low and Gaussian curves because that's not at work in markets. Because markets are not about going back to the average value, it's more about getting the fuck away from it as much as possible. So we don't actually care about value. We just care about how value improves into time to actually either prove us right or wrong. But as we enter and as we get into trading, the initial part of triggering a trade comes out of figuring out the conditions and meeting as much as those conditions to limit the risk of being wrong, okay? And markets decides whatever you want it or not, you definitely have no impact over this, okay? when you get to learn a new context, and there are many of them, a trading strategy cannot just be, all right, when this happens you buy, when this happens you sell. It's just definitely not about it. The markets are fairly more complex, and supply and demands are fairly complex structures. There should be multiple patterns in a decent strategy, and learning many of them is definitely the key to success. But this is definitely a hard thing to do, and it takes, like I said, on my personal strategy application, approximately 2 to 3 years to get there and to master each and every context I can teach you, okay? From the simplest one, the ones we're going to be talking about in the next podcast, up to the riskier context, reverse, counter-trendy trades and stuff like that, okay? And as you put them into real money application, go slow, because if you go too fast, you can actually, at some point, shock your brain and cause some rewind, which means you're going to destroy confidence. You're going to feel like you actually don't really know the pattern. So you're going to scroll back in time, lose a little bit of time in there. This is not a killing time of error. It's just a time confusing and time spending error that must be avoided as much as possible. So if you go too fast, you're probably going to know it easily and figure it out. Just step back for a bit, slow down the position sizing, go back for a little while, and then go back up, okay? That's really how these things go. Never stagnate, just go incrementally, and as you get shocked, just go back to the previous state, okay? And finally, this is what you need to understand. As you get to progress, this is not just all about you mastering the technique. You're definitely going to need to put this into real market territory, because if you don't progress on psychology. Progressing psychology is absolutely necessary, but generally delayed, because there is a process of you getting incrementally toward your final exposition. This is what will going to bring you money. Knowing the context is one step. Putting it into application is a multiple step thing that will lead you to full exposition of it, and this is where you're finally going to make money of them. You also need to understand that the easiest patterns I'm going to teach you are definitely mean something for harder context, and there is a way, there is a path in the way I'm going to teach you those things. The third range boundary, which we're going to be talking in the next podcast, is very important. It's not the most rewarding trade, definitely not, but it's very important for the process and learning how absolutely crucial it is for you to trend follow and stuff like that. Because yeah, when I'm going to be teaching you trend following, you're going to need to understand ranges first. And the third range boundary is absolutely key to many rational structures, including trend following. So that being said, I think we said more than enough for the day. So I'm just going to give you a quick recap out there so you get it. I mean, some people ask me for it. So you got a simple recap of what the key factors are, what things you should actually get to understand out of this video when you close it. That being said, I see you guys into the next one.